Today we're going to talk about the accounting cycle using a football analogy. I hope you got both feet in. So to understand the accounting cycle better, we're going to do a comparison with football. And how are we going to do that? Well, we're going to compare a business transaction with a football game when it happens. So we're going to pay a vendor some cash, we're going to pay them some cash for something. And that's going to be our business transaction. And then on the other side, we're going to have a football game happen. So what we're going to do is we're going to bring Dan Marino out of retirement here, and he's going to sling the ball around against the Dallas Cowboys, and we'll see how this compares to the accounting cycle. So now the next step we would do in the accounting cycle is journalize that transaction. Just like in the football game, we're going to record the results of that game, who won, who lost. So in our accounting transaction, we're going to record a decrease in cash and an increase in inventory for that amount of money we paid to our vendor for that inventory. In our football side, we're going to record the win by the Dolphins. I mean, heck, the guy came out of retirement. We're going to give him the win. And the loss by the Dallas Cowboys. And that's the second step of our accounting cycle. Journalize the transaction. So the next thing we're going to do is we're going to post that transaction to our general ledger. And by that I mean we're going to go into specifically the cash account, and we're going to add this specific transaction to its general ledger activity. So it's going to show a reduction in cash or a credit to cash for that purchase of vendor inventory. Then we're going to go to the inventory account, and we're going to see an increase in that by the amount of goods that we had purchased. Well, how does that relate to football? Well, if you think of the cash account and all the transactions that happen to it, that's what's like posting a game to the record of the team. So we're going to use the schedule of the Miami Dolphins and show that, well, a few weeks ago they lost to Arizona, then they beat Jacksonville, then they lost to Buffalo, but they beat Dallas this week. So their general ledger, so to speak, would show them 2 wins, 2 losses. But it's the accumulation of activity that's happened this season. That's what the general ledger is going to do for the cash account. List all the activity that has happened for the period to the cash account. And then when we go to the inventory account, it's going to show all the activity that has gone in and out of that for that same time period. So that's the comparison between the ledger and the schedule for our football comparison. So now what we're going to do is we're going to roll up all those accounts into their totals, all the ins and outs and pluses and minuses that those accounts have. And so we'll have our trial balance. And our trial balance is going to list each account, and it's going to show whatever value those accounts have at the time we roll up the trial balance. It's going to be listed once, and it's going to have the accumulation of every plus or minus that's gone on. So how do we compare that to football? Well, we're going to look at the standings. We're going to look at the standings and see how many wins and losses that each of the teams have had in our scenario. So that's how the standings of the football game have compared to the trial balance. So now remember, we've only played one game. We've just recorded it in our general ledger, and we've recorded it in the standings, and we've updated the standings. The same thing happens when we do a transaction in accounting. We journalize it, it shows up just once, but it goes to the general ledger, it goes to the trial balance. So next in the accounting cycle, we would have adjusting entries. And that's when we get to the end of a period, let's say, and we realize, oh, we ordered some inventory and we received it, but we haven't gotten an invoice yet. So we got to record the fact that we have that inventory and that we owe a vendor for that. So that's accounts payable. So we're going to record a special journal entry to record that transaction, and that's going to affect not only the general journal, but it's going to affect our general ledger for each of those accounts. So now how are we going to compare that to football? Well, we're going to go kind of out there on this one, but we're going to compare it to like a rules violation. Let's assume that there was some sort of rules violation and Miami forfeited the game. Yeah, no, it didn't have anything to do with you. It's just some sort of, violation that now Miami has to forfeit that victory and they award the victory for Dallas. Yeah, I know, it's upsetting. So as such, it's going to change the standings for each of the teams. Both Dallas and Miami are going to have their standings, their win-loss record changed. And that's similar to what an adjusting journal entry would do in accounting. So then, of course, our next step is going to be an adjusted trial balance because now we've redone a journal entry, we've redone a ledger. Now we've got to redo that trial balance, and we're going to have new values for our inventory and accounts payable on that adjusted trial balance. Just like in our standings, unfortunately for Miami, they're going to have a worse record, and Dallas is going to have a better record based on that rules violation. So that's how the adjusted standings in football is our comparison for the adjusted trial balance in the accounting cycle. So next we have our financial statements. Now that we've got those good trial balance numbers, we're going to have our balance sheet, we're going to have our income statement, we're going to have our statement of cash flows and our statement of retained earnings. All those are going to be prepared. It's kind of like in football when we have our final standings and we know who made the playoffs and who didn't make the playoffs. So when we look at the similarities of that transaction, that business transaction, and that one football game that was played, that one business transaction updated our general journal, just like the football game updated the box score in the paper to tell you who won. At the same time that business transaction updated our journal, it also updated the general ledger of those accounts. Just like that football game also updated the team's schedule of how many wins and losses that they had had. And our trial balance and our financial statements were also updated immediately by that transaction, just like the standings were updated for the football teams. So you can see how one transaction in accounting affects many reports, just like one football game affects many ways that you look at it, from scores to standings. But we're not done there. We've still got closing entries in our accounting cycle. That's when we close out the income statement and roll that net income or loss into our retained earnings. So we do that entry as part of closing up the financials. Just like in football, we'll have playoff games to end our season. They don't count towards our standings anymore, but it's something that we need to do to kind of resolve the season. So we'll clear out the standings and everyone will soon have a 0-0 record again once all that playoffs and Super Bowl are done. So then we'll have our post-closing trial balance in accounting, and that's similar to, again, wiping the standings out to 0. Everybody's got a 0-0 record to start our new season, just like we're going to start our new business year and start accumulating new transactions that update these, just like we'll start playing new football games to update the new standings in the new year. Well, I hope that gives you a good understanding of the accounting cycle, and I want to thank my special guest, Dan Marino. And remember, keep your eye on the ball and both feet in bounds. I'm Professor Hungerford. Have a great day.